So, hey friends, in a video that I did on YouTube the other day, I made the comment that I was going to give a very simple explanation to people as to why it looks like installment loans, things like student loans, car loans, and mortgages are so front end loaded with interest. In fact, some people think that it's a scam, that the banks are just, they're just, they're getting their interest first, and they're doing it at the customer's expense, and it's really not like that. I'll go through an example here, and you'll actually see how this is calculated, and I think it'll begin to make a little more sense to you. So let's take an example and just walk through it. Okay, so I'm on a website here called amortizationschedule.org. And I find this calculator very easy to use, very intuitive, gives you some good information. And what I like about it is it breaks down the payment schedule over the entire length of the loan. So what I've done here is I've set up an example, and what I'm going to use is I'm going to use $150,000. You can see here I put the parameters in already. $150,000, and I'm going to assume this is a student loan. And I know that sounds like a lot, but I'm certainly hearing people in certain situations that have loans that large. The term of the loan I'm going to say is 20 years, and just to keep the math a little simpler for me going forward, I am going to assume an annual percentage rate of 9%. Now, if you watched my video the other day, I made the comment that when we look at an annual percentage rate on something like an installment loan, a loan that you're going to be making payments, say, every month, for 20 years, that's really 20 times 12. That's 240 payments over the life of the loan. And in reality, you're not paying, you are paying a 9% APR, but really what you're paying is roughly a 0.75% interest rate a month on any outstanding balance. And so if I calculate here and say, okay, here's what this loan looks like. This website gives me some basic information back. You can see my original loan amount is $150,000. My monthly payment is $1,349.59. Now, if you pay that amount over all 240 payments, then you will pay your loan off under the terms listed. So 240 payments of $1,349.59 is going to pay your loan off in 20 years as agreed. It gives you the start date, gives you the payoff date, it gives you the total interest paid, which I think is always good for people to look at in terms of looking at, wow, if I could finance this for a shorter duration, or if I could finance it at a lower interest rate, you could really start seeing what a big difference that makes in terms of total interest. And then the interest and the principal loan amount are just added back together to give you the total payment. Then right under that, you actually have this nice little graph that shows you, as you make payments throughout the years, what portion of the total payment is going to be going towards interest and what portion of the total payment is going to be going towards interest. Now, if you'll notice right off the bat here, the early years are really front end loaded with interest payments, meaning the majority of what you pay when you make a monthly payment is going to be interest. Now, there's a very simple reason for that. The reason for that is you have essentially $150,000 of the lending institution's money right now. So you are going to be paying interest on a monthly basis. So if I look at a 9% annual percentage rate, that is 9 divided by 12, or 0.75% each and every month. See, that's really, really important to understand, because it really doesn't matter how many payments that you ultimately make. What it matters is the ever how much you have outstanding in your balance in any given month, you're going to multiply that times 0.75% to get the portion of your total payment that is going towards interest. So as you work that loan down, as you begin paying the principal off over time, then essentially your loan balance is going to come down, and 0.75% of that much, much smaller loan balance is going to be a much lower number, say at $50,000 than it was at $150,000, but your monthly payment is the same, which means that difference, that much more, is going to be applied towards the principal. So let's look at just the first couple of months here and see how this works. So my total payment, you can see over there. So my first payment, it says the interest paid is $1,125. Well, the reason that is if I take $150,000 and multiply that times 0.0075, I get $1,125. So $1,125 of the $1,349.59 is going towards interest. That means the principal has $224.59 applied to it. So we come to the next month. The next month, how much outstanding balance in the loan do you still have? Well, your remaining balance is essentially $150,000 minus that $224.59. That's equal to $149,775.41. And if I multiply $149,775 times 41 cents times 0.0075, I get $1,123.32, which again, if you look at the interest paid in that second month, is $1,123.32. Now, you paid a little less interest because your overall balance came down. You're paying a little more principal because your total payment hasn't changed. So as you can see, as I work this loan balance down through time, I am going to be paying smaller and smaller amounts of interest in each loan until I work that loan way down to some number where, and it looks like here, about 12 years into the loan, you actually start paying more principal than you do interest on any given payment. So that's how this works. Now, this is also one of the reasons why it's so advantageous to, let's say, pay additional amounts to your loan early. Because let's say that you've got this $150,000 loan. Initially, you're only paying $224.59 the first month towards principal. But let's say you came up with an additional $1,000. Well, you put that $1,000 payment in there with it, that all goes to principal. So rather than calculating the 0.75% interest against the loan balance of $149,775, you would be comparing that against a loan balance of $148,775. And your interest payment that second month would only be $1,115.81 as opposed to $1,123.32. So remember, you are paying whatever your monthly percentage rate is. So take your annual percentage rate, divide by 12. Whatever that monthly percentage rate is, multiply that times the outstanding balance on the loan, and that is going to give you the amount of interest that is being paid as part of your total payment. I hope this makes sense. If anybody's got any questions, feel free to comment. But it's a very, very simple concept. It's just that you're taking a lot of money out at the beginning. You're paying interest on all of that money. As you pay that down over time, or if you can pay it down sooner over time in bigger chunks, then the amount of overall interest that you're going to pay throughout the course of the loan is going to be substantially less.